Hello everyone. In this chapter, we'll discuss time frame alignment and time frame selection. This is one of the least discussed yet most important topics in trading. It often doesn't get the attention it deserves, but when it comes to CRT or ICT trading, it is a key concept that contributes to a logical trading framework. Without understanding the correct time frame alignment and time frame selection, your chart analysis won't be at optimal performance, regardless of how refined your other technical analysis aspects are. That's why knowing about correct time frame alignment and applying it logically and conceptually is crucial. In this chapter, I'll cover everything related to time frame alignment and selection. By the end of this video, you won't have any confusion regarding these concepts. The reason CRT works so well and achieves an incredible level of accuracy is due to this concept. All other CRT components work cohesively because of time frame alignment. This concept integrates these elements to make them meaningful and rational. Now, let's dive into the video. Time frame selection. The first topic we will discuss is time frame selection. This concept helps us understand the purpose of higher time frames and how to use them efficiently. It also helps tailor the process to your trading style and mental capabilities. Monthly time frame. The monthly time frame is primarily used for position trading, which involves trading ranges on the monthly chart. However, as you know, it takes an entire month to form a single candle on this time frame. For most traders, waiting that long isn't feasible. That being said, even intraday and swing traders can utilize the monthly time frame to establish a higher time frame directional bias or to better understand potential market movements. We will delve into this later, but for now, know that institutions and hedge funds often use the monthly time frame due to their large liquidity needs and execution challenges. As retail traders, our primary focus will be intraday, short-term, or swing trading, and we use the monthly chart to gain a broader market perspective. Weekly time frame. The weekly time frame is commonly used for swing trading, with trades lasting 1 or 2 weeks. Swing traders trade ranges on the weekly chart, but as intraday traders, we use this time frame to refine directional bias and determine higher time frame liquidity levels. Using a top-down approach, we first analyze the monthly time frame and then refine it on the weekly chart. This allows us to align with the higher time frame bias, offering higher probability trades. While sticking to the direction of the weekly and monthly time frames often leads to high probability trades, there are instances where counter-trend trades on lower time frames can also be valid. Daily time frame. The daily time frame is my favorite higher time frame. If I had to choose only one, it would be this one. The daily chart is invaluable because it suits both short-term and intraday traders. It provides assistance in identifying directional bias and liquidity draw levels using concepts like daily ranges, CRT market profiles, and key levels. These tools, when logically integrated, create a robust trading framework. The daily chart is the most optimal time frame for intraday and short-term trading. As an intraday trader, your goal is to trade within the daily candles range while aligning with the higher time frame bias. 4-hour time frame. The 4-hour time frame is essential for intraday trading and scalping. Most of your analysis as an intraday trader will be conducted on this time frame. You'll identify key levels here and match them with CRT concepts. Mastering the 4-hour chart's intricacies is critical, as it plays a pivotal role in defining your trading setups and aligning with higher time frames. Let's explore how different trading styles align with specific time frames. Position trading. Position traders trade ranges on the monthly chart. This style is typically used by institutions due to the long waiting periods involved. Retail traders generally avoid this approach because it requires significant patience and capital. Swing trading. Swing traders trade ranges on the weekly chart. This style is effective during market expansions, but since markets spend much of their time ranging, setups may take weeks to form. Short-term trading. Short-term traders trade daily chart ranges within a weekly range. They use the daily chart for higher time frame analysis and refine entries on the 1-hour time frame. Intraday trading. Intraday traders focus on trading the daily candles range. Trades are opened and closed within the same day, with no overnight holding. Scalping. Scalping involves trading the hourly range or smaller time frames, such as 5-minute or 1-minute charts. It's an aggressive style requiring quick decision-making and fast executions. Choosing the right trading style is critical. Self-evaluation helps identify the style that aligns with your personality. For instance, I discovered that I prefer intraday trading because I find it challenging to manage emotions when holding trades for extended periods. Your job is to experiment with different styles, swing trading, short-term trading, scalping, and monitor your performance and emotions. Once you identify the style that suits you, focus on refining it for optimal performance. Success in trading requires a balance between technical analysis, risk management, and psychology. Ignoring any one of these aspects can hinder progress. Many traders focus solely on strategies and neglect the psychological and risk management elements, leading to failure. To be consistently profitable, you must integrate all these aspects and create a balanced approach. Trading is not just about technicals, it's about understanding yourself and maintaining discipline. This concludes our discussion on time frame alignment and selection. In the next part, we'll explore higher time frames in more detail and their specific purposes. So here we've got a monthly time frame, right? And here I have chosen a small price section. Now, it seems pretty small, but this price section was formed over a year and a half and has a range of about 2,000 pips. The monthly chart is the first one you're going to start analyzing with, right? It doesn't matter if you're a swing trader, a short-term trader, or an intraday trader. You're still going to start off with the monthly chart to determine your directional bias. You're going to do that with different concepts, which we'll discuss, but at the same time, the monthly chart will also give you conviction in your directional bias and your drawn liquidity. The monthly chart plays a significant role in assisting your trading and analysis. Obviously, the monthly chart moves extremely slowly, but through our CRT, you'll see that the precision and accuracy I've achieved have a lot to do with the direction derived from the price section on the monthly chart. The monthly chart forms the basis of our trading and our top-down analysis. We start with the monthly chart, identifying a particular drawn liquidity or direction, which we then refine on lower time frames, such as the weekly or the daily chart. Comparatively speaking, if we consider the weekly and daily charts in relation to the monthly time frame, they are lower time frames. However, in the grand scheme of things, compared to the hourly or 15-minute time frames, they are higher time frames. Everything is relative, nothing is absolute. You must remember that. Now, as I mentioned before, I'm not a long-term position trader because I tend to change my mind often. I have an aggressive and swift personality, making me more suitable for intraday trading rather than position trading. I know I can't hold trades for long, and I tend to mess up if I do. That's why most of my entries are intraday trades or day trades, with an average duration of 4 to 5 hours. This is something no one really talks about in trading, finding a style of trading that suits you best. For instance, you might see someone who is a really good swing trader, holding positions for weeks and making consistent profits. Let's say they teach you their strategy. That doesn't necessarily mean you'll be profitable with it, because your personality might be different from theirs. Your mental capacity and capabilities might differ as well. It's your job to evaluate yourself, understand who you are, and determine the approach to trading that suits you best. Only you can do that for yourself. No one else can. You achieve this by taking trades, journaling your thoughts, analyzing your psychological responses, and assessing whether you're comfortable with the mental demands of a particular trading style. Now, the concepts you're going to use to analyze the monthly chart and determine your directional bias include quarterly shifts, seasonal tendencies, dealing ranges, key levels, CRT, and so on. Quarterly shifts and seasonal tendencies help you build a narrative. The other concepts then support your directional bias and help you frame a trade idea. We'll discuss these concepts in detail in future lessons. For now, I'm giving you an introduction to them. As we progress, you'll learn how to use these concepts to enhance your higher time frame analysis. Now, as an intermediate trader, you're not going to necessarily trade in the direction of the monthly directional bias, right, or drawn liquidity. You're still going to trade setups in the counter direction, because we all know that the markets never move in a straight line, and it always has ranging profiles and retracements before it reaches its targets. So that means, let's say, we've got a certain drawn liquidity on the monthly chart that we are looking for right now. Obviously, it's going to take weeks for price to reach there, and throughout this time price is going to be in different market profiles on the lower time frame. We're going to have retracement, we're going to have ranging profiles, and then expansions, right? We're going to have different styles of market profiles towards that direction. Now the retracement profiles on the high time frame are still tradable on the lower time frame, and you can counter trade them, because on the low time frame they'll be logically looked at as expansions or reversals. So that means inside of a high time frame expansion there are multiple lower time frame retracement ranges or reversal profiles, right? The higher time frame market profile is made up of multiple and various lower time frame profiles consisting of various types of it. We're going to discuss such advanced market profiles in terms of time frame alignment too in further chapters, so you can have a better and dynamic perspective to it, right? So the idea is that on the monthly time frame, you're going to use these concepts to build a directional bias, and then your long-term directional bias and drawn liquidity would be exactly that, and you're going to stick to that unless there is a change in market dynamics or price action on the lower time frame that tells you otherwise. You could also use this as a filter to manage your risk too. For example, if you find an intraday setup or a short-term setup in the direction of the monthly directional bias, then you could regard that setup as an A+ setup or a high probability setup, but if it's in the counter direction, you could comparatively regard that setup as an A setup or a lower probability setup, and you could then still trade that setup, but you're going to just manage your risk on that particular trade accordingly, right? That's exactly how I manage my risk on my intra setups too. Now let's discuss some price action here on the monthly chart. Now we know that there are different protocols for finding and selecting CRT correctly, and then using that CRT correctly. But on a fundamental level, the idea is that every single candle is a range, and every single candle can be treated as a range on its own. That's like the main statement of candle range theory. Now when one side of a CRT range or a typical range is purged, our drawn liquidity becomes the opposing side, right? Now we're not going to discuss the different protocols here because we're discussing time frame alignment, and that's a topic for another day. But we're going to keep that fundamental principle of CRT in mind, and we're going to look at this price action right here with that particular perspective. Now obviously you need to remember that if you were analyzing this price action in real time, and you would be using all those other concepts as well that I mentioned earlier, and use them together to reach a conclusion or to determine a directional bias. But for the sake of simplicity, we're just going to look at it with a fundamental basic CRT perspective, because we haven't yet discussed all those other concepts here. So once we discuss them and explain them to you in the later chapters, then we're going to integrate it with these principles right here, and we're going to look at it with a logical framework. But for now, this is what we are going to be working with. Now we know that when price engulfs a candle, that particular candle becomes a key level for us, and price uses that price action for future reference to react off of, right? Now keeping these two principles in mind, let's look at this price action. So starting off here, we can see the price took out this candle's low right here, and then it closed above and inside that candle's range. So now when price takes a candle's low, and then closes inside just before taking out the opposing end of the range, what happens is, starting with the next candle's open, our bias and our drawn liquidity become the opposing end of that range, and we start looking at that high as our drawn liquidity in our bias. In this case right here, you can see that price eventually took this high and closed above. So you can see that for this particular monthly candle right here, for the whole month, you would have had a bullish directional bias, because the drawn liquidity is high, and for this particular month you would be looking for longs, particularly on a short-term trading basis, right? And day trading basis, as I said before, you're not just going to necessarily look for just long or bullish trades, but counter trades too. But the directional priority would have been bullish for you during this month, right? Because the drawn liquidity is high. Let's move on to the weekly chart and look at that same price section with the weekly chart's perspective, So you can see that these significant highs and lows right here, where price made these reversals and these expansions, these highs and lows are the monthly CRT highs and lows that I just showed you before. Now right here, you can see that it's the monthly candle, and price purged this low with this candle, and then it closed above and inside of this range right here. So for the next weekly candle open, you would be expecting higher prices till the opposing range high is taken, which is this high right here. And you can see right here, for the next few weeks, we kept pushing higher in our directional bias for the time being, which was bullish. Then after price action closed above this high right here, this high became a key level for us because this high led to taking out liquidity, right? And now price is going to use this high as a key level and test it and expand from here. Such highs are called what? They are either called mitigation blocks or breaker blocks, right? So for the next week, you're going to expect price to retrace to this key level, find support there, and expand from there. Now remember, each one of these is a weekly candle, right? So you can see that you've got 5 trading days inside each weekly candle to trade, right? And you've already found your monthly directional bias, and now you've refined it even more on the weekly candle, and now you're going to trade on those 5 days with that particular directional bias that you've determined or that you found through this analysis right here. And you can see right here, if your logic and narrative were correct, you would be right for all these weekly candles, and your bias and your draw on liquidity would be better than most traders. You would have had better precision and accuracy in terms of directional bias than anything else, right? Now trading them on the lower time frame is a different topic in itself, and we're going to discuss that. In terms of directional bias, you would have a really high probability and accuracy if you determined and used this price action right here in this way on the higher time frames. Right now, again, right here, looking at this price action, you can see that once we tested this key level right here and retraced to this key level, for the next week, we would expect bullish candles and bullish prices in the opposite direction, and we would look for price to expand from here. Now with this candle right here, you can see that price expanded higher, and then with this expansion above, it closed above this candle. Now what that means is, we can use this candle as support or a key level, and price is going to test that and expand higher from here, because we know that closes above represent bullish prices, and closes below represent bearish prices. Similarly, again, when price closed above this high again, it tested and formed this FVG, then filled that FVG and expanded higher. Then what happened? We formed this monthly CRT, went above, and then reversed from there and closed inside that CRT. So our directional bias would then become bearish towards the monthly CRT low, which is this low right here. So you can see, again, using the same logic over and over, the rest of the price action here aligns with that perspective. Right now, I'm 100% sure that you are already looking at this price action with a different perspective than what you had before when you started this chapter. And that's the exact purpose of these chapters, to explain these complex and advanced concepts in such a way, in such a simple way, that everyone understands them. That's my goal with these chapters. Now, as I said before, the daily chart is mostly used by short-term traders and intraday traders, right? And you're going to use the same concept here again to analyze this price action and reach a conclusion regarding your directional bias for the day. You're going to refine all the analysis you've done on the monthly and the weekly chart and refine it down to the daily chart. Use it to assist you in finding a directional bias or a draw on liquidity. Now you can see there's a logical process and framework for how you're going to do that. Now your purpose as an intraday trader would be to determine your directional bias for the day and then trade in that particular direction, right? Predict and anticipate where the daily candle is potentially headed to or where it's going to potentially close, right? That's your job as a trader. Now these were all the different functions of each higher time frame, ranging from the monthly down to the daily time frame, right? What you should do is note all of these down and note all of their characteristics that I just told you about. Then remember what the purpose of each time frame is and the purpose each time frame serves. Next one we have got is time frame alignment. As I said before, It's one of the most important concepts when it comes to CRT or IC trading, right? And the way how CRT and all of these other concepts work so accurately and precisely is due to the correct integration of them through time frame alignment. So if you don't know how to align time frames correctly, then you wouldn't be able to integrate these concepts together in the most accurate way possible. So, in order to learn how to integrate these concepts together, you must know about the correct time frame alignment and the correct combinations of time frame alignment. So let's discuss time frame alignment. For each style of trading, there's going to be 3 main active time frames and other passive time frames. Now it doesn't mean that these are going to be the only ones you're going to use. You're going to still use other higher time frames too, but on a basic level, you should stick to these main active time frames if you're a beginner. Now we've got the higher time frame, the intermediate time frame, and last but not least, the lower time frame. Now the higher time frame is going to be used for 2 functions, for finding CRT and for finding key levels, and then combining them together and integrating them together. That's what the higher time frame is going to be used for. Then we have got the intermediate time frame, on which we'll determine structure and order flow. Structure is basically seeing whether price is breaking highs and rejecting lows, or it's rejecting highs and breaking lows. That's what we call structure on a fundamental level. We're going to discuss structure in detail too in other chapters, but on a fundamental level, that's what we regard structure as, right? Then we've got the lower time frame, which will be used for 2 functions. For profiling the market, meaning using market profiles to expect or anticipate other profiles, and then using the lower time frames for taking entries and finding entry setups. That's where you're going to execute your trades on. So these are going to be the 3 main time frames we'll use for our particular style of trading. Now let's discuss some different time frame elements for different styles of trading. So the first one we have got is swing trading. For swing trading, our higher time frame will be the monthly chart or the monthly time frame, and we're going to use it for 2 functions, which I mentioned before, marking out key levels and finding CRT. Then we've got the daily time frame, which will be our intermediate time frame, and we're going to use it for determining structure and order flow, right, through different concepts. And then last but not least, we'll be profiling the market and finding entries on the 4-hour time frame, which will be our lower time frame for swing trading. So for swing trading, these are the main time frames that they'll use to accurately and correctly do a top-down analysis, right? This is how you're going to do your top-down analysis as a swing trader. Next one we have got is short-term trading. For short-term trading, our higher time frame will be the weekly chart for finding key levels and finding CRT and then matching them together. Then we've got the 4-hour time frame as our intermediate time frame to determine structure correctly. Now one thing you need to remember is that we're not talking about conventional market structure here, right? Because conventional market structure shifts. Those things don't work. We're going to determine market structure in a completely different manner with a logical framework, which we'll learn in a different chapter. But for the time being, let's discuss time frame alignments for now. So the 4-hour is for structure. Then we've got the 1-hour time frame for our lower time frame entries and profiling. Next one we've got is intraday trading. This is my personal style of trading, and this is how I trade, right? Now I don't want to force a certain style of trading on you, and as I said before, you should find your style of trading on your own by experiencing each style of trading and self-evaluation, so that's up to you. For intraday trading, we've got the daily and the 4-hour time frame as our higher time frames. I specifically use the 4-hour as my higher time frame, but when price action is not clear, you can use the daily time frame as an alternative too, so you could see the bigger picture. Then we've got the 1-hour time frame for structure, so the intermediate time frame. And then last but not least, our lower time frame for entries and profiling the market is the 15-minute time frame. Now what you need to remember is that even as an intraday trader, you're still going to use the monthly chart, the weekly chart, and the daily chart, because that's going to provide you a higher time frame perspective and a higher time frame directional bias. But your main time frames as an intraday trader will be these 3 ones right here, right? Then last but not least, we've got scalping. For that style of trading, the correct time frame elements are the following. You can read it right here. This is how you use time frame elements in the correct way. In this video, I explained the different time frame elements. I explained how you can use the correct time frames for your trading and for your style of trading. I explained different styles of trading to you. I explained and defined different models to you, right? This was Chapter 3. Hope you've enjoyed it. Hope you've made notes because that's how you learn as a trader and evolve as a trader, right? Thank you.